Well, we would describe the current macro environment as one of resilient growth, but slower and more uneven disinflation. Because you see, the global economy has held up better than many expected. Labor markets remain relatively solid. Corporate activity is still supported by investments, especially AI-related capex, and consumers have not weakened dramatically, at least. At the same time, inflation is cooling down, but not in a straight line. And that's because services inflation, wages, and geopolitical risks have continued to make the last part of the disinflation process less of a straight line, more complicated. So yeah, central banks and inflation are absolutely interconnected. Central banks remain data dependent, as we know, but the key point is that they need confidence that inflation is continuing to move sustainably back towards target before they can ease with confidence. So our base case is that policy rates will gradually move lower over time, with the key word there being gradually, so not as quickly as markets have sometimes hoped for. So in terms of risks, the main risks that we monitor are certainly the fact that inflation could prove stickier than a lot of people would hope. Geopolitical shocks, of course, especially through energy prices, and then the possibility that higher rates do eventually weigh more visibly on growth or credit quality. So for investors, this means the good news is we're in a world where yields are higher and fixed income can go back to provide the most important thing, which is yield. That said, it is very important that one remains selective. So selectivity remains essential. It has been, as we know, incredibly volatile, and investor sentiment in the bond market has been quite shaky for the first few months of the year, and it remains somewhat cautious. I suppose for many years, investors did not need to think very hard about bonds because yields were so low. And then 2022 came, and it was a very painful reminder that bonds can also be volatile when inflation and rates move sharply higher. So today, the conversation is different. Clients are again looking at fixed income as a genuine source of income and potentially of total return. So not just as a defensive allocation. Starting yields are attractive, and that creates a much better cushion also to protect investments from price fluctuations. At the same time, the clients we talk to are definitely not complacent. They are asking very precise questions. How much duration should I take? Should I be in government bonds or credit? Is high yield still attractive? So should I consider structured credit, emerging markets, or private markets? So the signal we get from clients is bonds are back, but not in a passive or indiscriminate way. Investors want income, resilience, and diversification. And they also want managers to be selective, flexible, and very aware of downside risks. We see several opportunities in fixed income. Again, the key message being selectivity, but generally we are quite constructive on duration, not so much at the long end, but the mid to short end of the curve. We definitely see some opportunities there. We also see value in spread sectors, so non-government bonds, but mindful of the fact that spreads, as we know, are very tight. So investors do need to be paid properly for the type of risk that they're taking. We do not see much value in going down the credit quality spectrum, so we have a preference for high quality bonds. And as far as non-corporate risk is concerned, we see value in structured credit and select emerging markets. Emerging markets in particular as a diversifier right now make a lot of sense to us. And the yield premium can still make sense, but again, with careful research. So yes, bonds are back. We would definitely agree with that, but this is not a market where investors should buy everything. The opportunity is absolutely real, but it requires selectivity, risk management,